right, good afternoon or good morning, everyone. How's everyone doing today? Good, wow, that was sleepy from break. How are you all doing today? Excellent, thank you. I feel like my 5-year-old's kindergarten teacher. All right, so today we're going to talk about one of those things I like to call the iceberg issues, which is one of those things where it looks like it's all above the surface, right? It's so obvious, clearly understandable, etc., except so much of the RMD rules are really more complicated than they would appear at first. So much lurks below the surface. And if you've never been at a presentation before where I've talked, by all means, I encourage questions throughout. So if you have a question, stop me on that slide. We've got an hour and 15 minutes together today, and let's make the most of them. So if you have a question, let's not leave it for another day. Let's do it while it's up on the screen. It's a lot easier to do it while it's there than to go back afterwards, and I'll make sure that we finish on time. All right, so with that said, let's go in and start at the very beginning, which for required minimum distributions, and our focus is going to be lifetime distributions. For required minimum distributions, what we're looking at is when the required beginning date for all IRAs is April 1st of the year following the year the client turns 70 and a half. Probably nothing that any of you haven't heard before. Again, the required beginning date for all IRAs is that April 1st of the year following the year the client turns 70 and a half. Notably, that does include SEP and simple IRAs, all IRAs, which is a little bit weird. You know, SEP and simple IRAs are kind of like the amoebas of the IRA world in the sense that at times they act like IRAs and at other times they act like plans. For instance, if you're 70 and a half and you're actively working, you can contribute to your SEP or your simple IRA, but you can't to a traditional IRA. So you say, okay, they're plans. And yet, when it comes to required minimum distributions, they hop over from being like plans to being like IRAs, and you've got to take money out. So essentially, if you're still working at 70 and a half, it becomes like this revolving door of IRA money. You put money in, you take money out. You put money in, you take money out. Now, for plans, and when I say plans, I mean non-IRA based plans, so this would be your 401k or 403b, etc. The general rule is the same April 1st of the year following the year you turn 70 and a half rule, but there are a few exceptions. Two we're going to talk about today. The first being the still working exception. Now this is the most important one we're going to talk about because it probably applies to a good number of your clients. What the still working exception does is it allows us to delay required minimum distributions until the year the client separates from service if they're still working and meet a number of conditions. Now you say, well, how many people are still working past 70 and a half? Statistically, it's about 30% of all individuals past 70. So it's actually a pretty good number of individuals, right? It's not all of your clients, but a pretty good number of them might still be working past 70. But this still working exception is perhaps one of the greatest, if not the greatest example of the chaos, complexity, and utter absurdity that is the tax code. So let's start with this. It's called the still working exception. So if you want to use it, what do you think you have to do or be? Still working. Yes, that would seem to be logical. So here's my question. What defines still working? How many hours? How many days? How many weeks? What defines still working? I'm glad you're all looking at me like deer in headlights because I don't know either. There's no good answer. The IRS has never issued guidance on this, and so essentially, still working has become known to essentially be, does the company consider you an employee as of the end of the year? Doesn't matter whether you're working a full-time job 40 hours a week or a part-time job 20 hours a week. You could go in and work 5 hours a week, 5 hours a month potentially even, if it's a true employment situation, and you will still be working if the plan considers. Yes, ma'am. Self-employment, still working, but we're going to run afoul of some other rules in all likelihood because when you're self-employed, you own the business, which gets to the next item on this list, which is you cannot be a 5% owner. That's what the tax code says. You're not allowed to be a 5% owner of a business, okay? Obviously, if you're self-employed, you generally own 100% of the business. right? You own more than 5%. Now, interestingly enough, the tax code says you cannot be a 5% owner. I mentioned this is a great example of the chaos, complexity, and absurdity of the tax code. So what do you think defines a 5%? Like, how much do you have to own to be a 5% owner? 5% is what a lot of people are saying, because that seems logical. How do you get to be a 5% owner? You own 5%. And yet, that's not what the tax code says. It points you to another direction. It says, as defined by. And you flip the page and you go to that section, and all of a sudden you see a 5% owner is defined by someone who owns more than 5%. Now, that may seem like a matter of semantics, but imagine this. Imagine you've been working somewhere for the last 20, 30, 40 years, and your employer comes to you and they say, you know, I really appreciate all the hard work you've been doing. I want to make you a partner in this business, and I'm going to give you 4%. Sounds chintzy, doesn't it? Sounds cheap. Like what, you couldn't come up with the extra 1%? 5%, I want to make you a 5%. Doesn't that sound so much better? You would be surprised how many people you run to who own exactly 5% of the business. And if all you do is read that top line, you can't be a 5% owner, you might accidentally tell them they have to take an RMD when in fact they can still maintain deferral. And by the way, if they're still working, that deferral may be even more valuable than otherwise because they're generating income from work. They don't want to have additional income. So you can't be a more than 5% owner. Then we've got to look and say, what about other people? For instance, it's not just your ownership. We've got to use the attribution rules. So you got to look and say, how much do you own? How much does your spouse own? How much do your parents own? How much do your kids own? If the combination of those exceeds 5%, you are no longer you are a 5% owner. In other words, if your spouse owns 3% and you own 3%, you're both 5% owners and you can't use the still working exception. Now, those are kind of the downsides. The good thing is that this is not an forever decision. This is not an annual test. We don't go and do this every single year and say, hey, are you a 70.5? Are you a 5% owner this year, rather? No? Okay. Are you a 5% owner next year? Yes? Okay, you can't do it this year, but you could have. No. It's a one-time test. The tax code, which is above everything else, even above the regulations, is very clear about this. It says, the test shall be in the plan year ending in the year the client turns 70.5. It's a one-time test. Now, a few things to keep in mind. First, to the disadvantage of someone. Let's suppose that you were 72 years old and you decide, you know what, I want to sell my business. Well, first off, if it's like an inter-family sale, right, you're selling it to your child, or you're passing it down, it doesn't matter. Even if you gift it, you're always a 5% owner because of those attribution rules. So you can't use this. But let's say it's a true third-party transaction. You're actually selling it. If you sell it at 72, but you continue working, right, for a lot of reasons, people stay on as like a paid consultant for a number of years. Some of you may have that as your own plan in terms of your own business trajectory. When you retire or you start to tail end your career, you may stay on as an employee to consult for a number of years to ensure a successful transition. That's very common throughout a number of businesses. Well, if that's the case and you did it when your client was 72, even though they own 0% of the business at 73, 74, 75, when they're still an employee, they are treated as though they are a 5% owner because the test is performed one time. Essentially 365 times, right? It's every day in the year that the plan year ends and the year the client turns 70.5. But that's it. Once we're out of that year, it's over with. So if you were an owner of 5% or more than 5% any time during that year, you will forever be a 5% owner. Now, similarly, let's say you're not. Let's say you sold at 69 and you stayed on as a transition. Well, there you could use the rules. Or here's an interesting one. This is a bit more aggressive, so I would say this. I'm generally a conservative tax preparer. For a lot of different reasons. I just don't want to deal with the IRS nonsense. The whole argument of you'll win in court is great when you're an attorney, but not when you're anyone else. That's typically been my experience. And so I try to be relatively conservative. However, I will tell you that in this area, what I'm about to share with you, I would give it on the aggressive side because IRS has never formally blessed it. But the tax code is exceedingly clear. It says one-time test in the plan year ending in the year the client turns 70.5. So here's the question. Your client who has had all this knowledge inside their head, right? A few things to think about here. What if they separate from service at 72 from their employee job, but they decide they don't want to just sit on their butts? They want to go back to work. They want to do some external consulting. They become a sole proprietor. Well, how much of that business did they own prior to the time that they were 72? Zero. It didn't exist. There was no business. And therefore, if they went back to work and created a 401k company, now, can't be a sham. You can't say I'm working and no revenue's coming in and it's just a bogus transaction. But if they're truly working, they should be able to create their own 401k plan. And by virtue of the fact that they owned 0% of the business because it didn't exist, they should be able to avoid RMDs until they retire. Again, just because that one has not formally been blessed by the IRS, I would get your client's CPA, if it's not you, to sign off on that, but that seems pretty clear. Now, some other thoughts here that are a little bit less aggressive. Let's say your client wants to retire and they're just an employee, they're not an owner, but they would like to defer RMDs. They just don't need the money, they don't want the extra income. Here's something to think about. Imagine your client was an engineer and for the last 40, 50 years has been working and gathering knowledge, and they're just a brain full of incredible information, and they're about to leave the workforce. What a loss to the employer, right? What if they went to the employer and said, listen, I really want to take my time and spend some more time with my family, my grandkids, etc. But here's what I'm willing to do. I'm willing to come in, twice a month for 5 hours at a time and sit down with the other people that are still working here and help think through some of these more complex issues. I'd like you to keep me as an employee part-time for that work. Well, if the company considers that person an employee as of the end of the year, they potentially can use the still working exception. Might be a really good thing, not just, again, for the tax deferral, but just to keep that person's, mind sharp, et cetera. These are the type of things we can think about as we go beyond just tax planning, but into essentially more life planning, coaching, et cetera. And also, if your client is still working and has the ability to defer RMDs in one or more of their plans, generally it's going to be one, because it only applies to the plan of the company they're still working for. But we can generally, if the plan allows, roll in dollars from other places. So maybe they have IRAs, maybe they have 401ks from old employers. We can funnel all of that into the plan of the company they're still working for, and now they don't have to take any RMDs from any of those plans. That's pretty powerful stuff. Pretty powerful stuff for clients. All right, now the other exception, yes. What if the place they worked is a state tax exemption for their retirement income? Okay. Good question. So I think I understand what you're saying. You're saying they worked for, let's say, I'm going to use an example, New York State. And they have a New York State 403B, and they go back to work somewhere else. And the New York State 403B would be tax exempt to New York State. The question is, if they roll it into a 401k of a private employer, does it retain its status? Is that about right? So the answer is it depends on the state. I can tell you I live in New York. New York State has a number of advisory opinions where they've allowed that. You have to keep track of that information and keep track of the monies that went in, and you have to report it on the tax return. And more often than not, New York will say, why isn't this subject to New York State tax? And you get into a letter writing campaign. Other states allow that too. I cannot say definitively that all of them do, so worth looking into for sure. So it's a good question. In general, my understanding is states will allow you to do that as long as you keep track, but I don't know all 43 states or whatever that have income tax rules. So that's a good thing to look up in your own state. Good question. And one other point here, just before we move on, when I say you have to be working through the entire year, I do mean the entire year. For instance, for some reason, I shouldn't say for some reason, obviously, the end of the year is a clean break. You say, I'm going to retire, I'm going to go into work on December 31st, that'll be my last day, and in 2020, I'm going to be retired. Well, if you do that and you go into work and you leave at 5 o'clock on December 31st, you haven't worked through the end of the year. You literally need to be an employee at 11:59 and 59.9999999 seconds on December 31st. So what I really mean is if you want to use this and you're retiring December 31st, go into work for an hour the following year. January 2nd, go into work, clean out your desk that time, have the company pay you. This way you can be able to use this deferral for another year. Because once you retire, there is an RMD for that year. So even if you retire on December 31st, you have an RMD for that year. Now, you don't have to take it December 31st. You could wait until April 1st of the following year, but there still is that RMD for the previous year. All right, the second one I want to bring up here is not so much one that I bring up because it's a good strategy that you should all know, like the still working exception. I bring this up more because a lot of times people misapply this because they tend to get their advice not from you, the people who actually know what they're doing, but from the other people they work with who have no idea. For instance, my wife is a neonatal nurse practitioner. She works in a hospital. Well, when she started working, at her first job, she was talking to someone who was getting ready to retire. And she said, this is, and they found out, they knew what I did, and they were talking about things, and she said, well, I'm going to leave my money in this 403B because I don't have to take required minimum distributions until I'm 75. And why did she think like this, my wife's coworker who was getting ready to retire? Because when she started working, someone else was getting ready to retire, and they had that benefit. There was a rule that said if you have a balance in your plan as of December 31st, 1986, then that balance doesn't have an RMD until you turn 75. But it is just that balance. So people retiring today, it's virtually nothing. And by the way, if you took any voluntary distributions over the years, guess what balance those first go to reduce? That pre-87 balance. So it's virtually non-existent for people retiring today, and yet all the time I run across people saying, we have a special rule. We don't have to take RMDs until we're 75. It's generally not true. So I bring this one up so you know to appropriately rebut that. Doesn't mean that an IRA rollover is definitively the right option, but if the reason someone is not doing the IRA rollover is because they tell you they have a special age 75 year rule, it probably is not true. All right, let's move on and talk about who calculates the IRA. In general, if you're an IRA owner, the custodian has to either calculate your IRA RMD for you or at least offer to calculate it upon request. Plans are generally not subject to the same rule, but here's the catch. The custodian has to offer to calculate or calculate that RMD, but they don't have to calculate it correctly. Right? Now, how can that be? Well, it's because the custodian can use certain default provisions. And you say, well, if they do that, then surely they're responsible. Nope. This is right from the IRS website. I only bring this up here, and these slides are in your app, so if you need any of this information, you have it all. But bottom line, the IRS says if your RMD is from a individual retirement account, or for that matter from a 401k, it's your problem. You put the information down on your tax return, and I don't care what the custodian says. At the end of the day, it's your problem if there's a mistake. And so with that, why are there so many mistakes? Well, it shouldn't be. There's only 4 things we have to do right to get an RMD to be correct, but there are mistakes with them. What are those 4 things? Well, in short, we've got to have the right life expectancy factor. We've got to have the right year-end balance, right? We've got to take it from the right account, and we've got to take it in the right time. Those are the 4 things. So let's go through each of them. First, let's talk about the life expectancy factor. There are 3 tables. There's the uniform lifetime table that hopefully most of you are comfortable with. There is the joint lifetime table, which some of you may be familiar with, and then there's the single lifetime table. Let's start with the single lifetime table. The single lifetime table should never be used for people during their lifetime, ever. Does not get used. It only applies to beneficiaries when it comes to required minimum distributions. Now, for for owned IRAs, for your own accounts, generally speaking, overwhelming majority of your clients use the uniform table. That's the one that starts, you see all the time at 70, right? And it starts at 27.4, then 26.5, and so on and so forth, right? Starts at 70 and usually goes up to 115, I think. And then afterwards says 115 plus, right? Like we have to deal with that today. All right, so I digress. Bottom line, uniform table is the one that's used for the majority of your clients. Now, there is a special table that applies, the joint lifetime table, when clients are married to someone who's more than 10 years younger than them, and that's their sole beneficiary of the account. Now, sometimes when you understand why a rule exists, it's easier to remember it. So anybody know why we have a special table for someone who's more than 10 years younger? Well, how many of you were practicing back like in the early 2000s when it was even more complicated than it is today? We had things like term certain and recalculation and all these wacky RMD rules, right? You remember that? Well, in the simplification of the final regulations that IRS put out, they said, okay, we've got to simplify this. How can we do that? And the way they did that was by pulling an Oprah. What did they do? Well, you know, Oprah, right? She gives away everything. That's what the IRS did. They said everybody gets a spouse who's 10 years younger than them. Quick, look under your seats. It's a spouse who's 10 years younger than you are. You have one who's 10 years younger. Everybody gets a spouse who's 10 years younger. And in fact, that's what the uniform table is. It's a joint table of someone who is your age, the age you're looking at, and someone who is exactly 10 years younger. But then the IRS said, well, what if they're really married to someone who's much, much younger? Then we let them use the other table. So by default, the uniform table gives you that age of a 10-year younger spouse. Custodians generally won't take into consideration the joint table, even if they have on file that your sole beneficiary is your spouse and that spouse's birthday is on file. So if they're calculating it and you're not using it, you may artificially be calculating a too high RMD, resulting in unnecessary taxation. Good news, it's not a penalty. Bad news is you're accelerating taxation needlessly for clients that are trying to minimize it. So that's the table. This is the one I was talking about. Again, starts at 27.4. But here's my question for you. And the next slide I'm going to show you is nothing special from a technical perspective, and yet it may be the best thing you see in the next hour or so when talking to clients. Does anybody ever talk to people and say, take out 127.4 of your account? No. No one understands this. People look at the table and say, how much do I have to take out? Well, one of the things I did a few years ago, which has just been absolutely amazing, the type of conversations it has, is I converted it to a percentage. And all of a sudden, you're talking to a client, you say, well, when you start, you have to take 3.65% out of your IRA. Clients get that. It's amazing the difference in conversation you have just by switching over and talking about percentages. So this one page, if you have it, I would, again, it's in your slide app, I know, but print this out, put this somewhere, and talk to clients about percentages. Not divide your account by 26.5 when you're 71. Just doesn't mean anything to them. All right, let's now talk about calculating the correct balance. Again, it should be relatively simple. It is at least better than it was years ago because now there are only 2 times that we have to change the year-end balance. It used to be 3. Okay? So what do I mean by this? Well, in general, when we have to look at the prior year-end balance, the way we would do that is by looking at the December 31st statement from last year, right? And just see what it says. What's the closing balance? Or if you're a real rebel, you can use the January statement and look at the opening balance, right? Ooh. All right, so now that we've got that, you say, okay, that's what we divide into. That is usually the case, but not always. And there are 2 times we have to adjust it. The first is when there's an outstanding rollover or transfer. What do I mean by that? Well, let's use a nefarious client first, okay? Your client calls you up on December 28th and says, I am so sick and tired of these required minimum distributions. I never want to deal with this again. Send me the $1 million in my IRA. I'm so tired of RMDs. You say, well, that's just not right. You're going to pay taxes. They say, I don't care. Send me the $1 million. So you do what the client says, and you send them a check for $1 million. And you're like, wow, this is not a good deal. The client calls you then up a couple weeks later, January 15th, says, hey, you remember that $1 million check I sent you? I'm going to send it back. Would you do me a favor and roll it into my IRA? Well, what's their prior year-end balance? 0. Therefore, no RMD, right? Doesn't work. Congress was ahead of people on this one. They said, if you have an outstanding amount as of the end of the year, you've got to add that back in. Now, I gave you a nefarious client, but imagine this. Imagine your client is retiring, December 10th. That's their last day of work. And what do? You get on the phone with the 401k because you've decided an IRA rollover makes sense, and you call, and the plan says, sure, we could do this. We're going to send you a check. It takes 7 to 10 business days to process, right? So by the time the client gets the check, it's like December 22nd. They're in the middle of the holiday season. You're not in the office. So what happens? The check sits in their desk drawer until January 2nd, January 3rd, sometime early the following year. And they come into the office and say, here's my check. Put it in my account. Well, what's the RMD? The custodian, the IRA custodian, is going to tell you 0 because that was the balance. And you know what? The custodian is not wrong. They're able to say that. But you are going to have to be the one to adjust that. So if you think about how long rollovers take, especially at the end of the year, it's not uncommon for things to cross over innocently over that year-end deadline. It's up to you to make sure that they're adjusted. Also here, excess QLAC payments, then I'll take the question. Excess QLAC payments, what does that mean? Well, some of you may be aware, and we're going to talk about them in a bit later, of these qualifying longevity annuity contracts. If you put too much in, you can fix it by December 31st of the following year, not October 15th, like other excess contributions, but December 31st. That excess that's returned from the QLAC, that has to get added back as well. The third one that used to be in existence but no longer applies is Roth IRA conversions. If you did a conversion, let's say December 28th, right, you could have a $0 balance because there's nothing in your IRA, it's all in a Roth. But then you recharacterized the following year, you had to adjust that. Obviously, we don't have to worry about that anymore, so it makes this a little bit easier. Yes, sir? Good question. So what if I have a spouse who's the sole beneficiary is much younger, more than 10 years, but we've been using the uniform table, essentially, not reducing it to the joint table. Can we go back? You can't go back in time and put the money back in, but you could change it going forward. Absolutely. And to the point, this year, if you happen to be within the last 60 days and you took that RMD, anything above the RMD would be excess. You could roll that amount back in. Let's say the RMD was 10, but you took 12 because you thought that was the right one. You could roll back the 2,000, assuming you were within the last 60 days, and you haven't done another rollover within the past 365 days. 60 days. Oh, the table? You can go forward indefinitely. To roll over the excess? It has to be within 60 days of the distribution. Actually, technically, 60 days of the receipt of the distribution. There we go. All right. Now, let's talk about when to take it. Now, interestingly enough, when you go to school, right, you start easy and you get hard, right? Like elementary school is harder than kindergarten, then junior high gets more difficult than high school, then college a little bit more difficult than that. And then as some people go on, they get their masters, right, and higher education degrees. Well, when you're taking RMDs, it's the backwards. You start with like your master's class. It's the most complicated the first year. After that, it gets much easier because there are different deadlines and potentially different year-end balances that have to come into consideration. For instance, let's consider the case of Nick and Nora. Now, you don't know Nick and Nora, but I'll tell you a little bit about them. Nick and Nora are twins, and they were born in 1949. Okay? Now, Nick, oddly enough, was born at 11:58 p.m. on June 30th. Nora was born 5 minutes later at 12:03 on July 1st of 1949. Now, if we fast forward 70 years, Nick turned 70 on June 30th of this year. Nora turned 70 on July 1st. That means that Nick will turn 70 and a half, the latest point during this year that's possible, on December 30th, right? I love seeing the looks as some people realize you can't turn 70 and a half on December 31st. That's the first time it's always like, oh, yeah. So Nick turns 70 and a half on December 30th, the latest date, right? Because there's no June 31st. Nora, on the other hand, turns 70 and a half when? January 1st next year. Well, here's the thing. Nick and Nora, they're twins. They've done everything together their whole lives. And so Nick says, in an effort and a show of solidarity, I'm going to wait until next year before April 1st, and we're going to take our RMDs together like a little twinsy team. So on March 1st of next year, 2020, they get ready to take the RMD. Now, Nick in 2020 and Nora in 2020, they'll each turn 71, right? So Nick taking his first RMD, what's the factor that he uses? It's a 70, age 70 factor. Because even though he's taking the RMD next year, he's taking it for this year. And he turned 70 in this year. Now, Nora, on the other hand, is taking her first RMD. Therefore, she will use the age 71 factor. Now, how about prior year-end balances? What prior year-end balance does Nora, who turns 70 and a half and 71 next year, use? December 31st, 2019, right? How about Nick? 2018. So even though he's taking it in 2020, we have to look back all the way to December 31st, 2018 to figure out the balance to use. And that catches a lot of people off guard. But one of the things you can do to clarify this is to understand a seemingly ridiculous statement, which is the following. The distribution year is not necessarily the year in which you take your distribution. Okay? Now, everything is tied to the distribution year, which is, again, not necessarily the year in which you take your distribution. I'll give you an example. Let's say somehow you forgot to take RMDs for 5 years. You wouldn't make all those RMDs up using your current age and the current prior year-end balance. You'd go back and essentially recreate it. It's the same thing with this first year of required minimum distributions. All right, so again, we talked about this. I'm going to skip through. You have this slide there. But bottom line is different timing and so forth. Now, I am really hopeful that this is going to be a positive experience in the next 5 minutes or so. I want to talk about a huge issue, which is RMD aggregation. Now, the reason I'm so optimistic is last year I was here to do a couple presentations, and one of them was on IRA mistakes, and we talked about this. Now, I have done this program, you can see here, a couple of years ago, probably about 6-7 years ago, created a program with Horse's Mouth, which some of you may know from their Social Security and Medicare programs, et cetera, but created a program where similar type of education experience for IRAs in the, for advisors in the IRA area. And what we did was, before the test actually went out, they wanted to know, do advisors really need this information? They said, you know, Social Security, Medicare, these are kind of like ancillary services that advisors can do to, you know, engender themselves to clients and to gain goodwill, provide a holistic experience, but there's not really revenue tied directly to them. In other words, like you do a good job Social Security planning, it's not the direct lead to revenue that, say, doing a rollover is, right? And so they said, surely advisors get this information from their, you know, from their own companies. And so we put out a test of 7 questions. Interestingly enough, more than half of advisors got more than half the questions wrong. And on 3 of the questions, this was over 500 people, so a statistically meaningful, you know, number of people took this exam. And on 3 questions, advisors scored so poorly that if I had given my 5-year-old a crayon and said, hey, close your eyes and circle an answer, he would have statistically scored better. So we gave 4 multiple choice. You can see here, 18% of advisors got the question right for the RMD aggregation question. So with that, I want to see how you do. And my hope is that since I was here last year and I talked about the same thing, that enough of you had this. I have now asked this question well over 100 times in presentations, and never have we gotten even a third of the room to get this right. So here's the question. Your client comes to you, a new client. They say, I got 2 goals. I'm a simple guy. I'm a simple girl. Just 2 things. Here's all I want. I want to avoid penalties. That seems logical enough, right? And I am so sick and tired of all this paperwork. Stop with the paperwork already. Let me take distributions from as few of my accounts as possible. Right? So in other words, I got a bunch of accounts. I'll tell you what they are, but tell me how many I absolutely have to take distributions from in order to avoid a penalty. And they tell you that I've got 6 accounts. I've got 2 IRAs, 2 401ks, and 2 403bs. Okay, 2 IRAs, 2 401ks, and 2 403bs. So the question is that I'm going to ask you, how many accounts do we absolutely have to take a distribution from in order to avoid a penalty? In other words, can I just take them all and total them up and take them from 1? Can I take 1 from each and there's 6? So even though we gave advisors on the online test only 4 choices, we are here live today. We could do 6, right? It's easy enough. There's only 6 possible choices, right? You know, if you say 7, I'm a very, very fair guy, but if you say 7, you do have to get up and leave now. That's just, all right, so everybody do me the favor and raise your hand for the answer you think is right. Let's just see how we do as a room. Ready? How many say 1? You could total everything up, make sure you get the right amount, and then take it out. 1 account. 2, 3, 4, 5, 6. All right. So I think we got about 10%, so that's pretty good. The answer is 4. There's always one person like, 4? How'd you get 4? So how did I get 4? By the way, the good news is some of you, no one raised their hand for 6, which was very interesting. Some of you raised your hand for 5, and the good news is, presumably, you at least didn't cost the client a penalty, right? The bad news is it's still the wrong answer. Now, for those of you who said 1, 2, or 3, we have a problem, right? And a significant one, because this is not a wacky question that it never happens in practice, right? Every one of you has a client with an IRA and a 401k that's 7.5 or older. So what are the rules here? Well, let's start with IRAs. You know the rules for IRAs, right? If you've got 3 IRAs and there's an RMD from one of 4,000, an RMD from another of 5, and an RMD another from 6, that's $15,000. I don't care how you get it out. Just get $15,000 out of any combination of IRAs that you want before the end of the year. $7,500 from 2 of them, $5,000 equally from 3, $15,000 all from, I don't care. Just get $15,000 out. Now, when it comes to plans, every single plan in general requires its own distribution calculated and its own distribution taken from that plan. So even if you had 2 401ks, you have to calculate and take separately those 2 401k RMDs. So switching my $4,000, $5,000, and $6,000 RMD example from IRAs to 401ks, you now have to take at least $4,000 from 401k1, at least $5,000 from 401k2, and at least $6,000 from 401k3. There is one exception to that rule for plans, and only one: 403bs. With 403bs, it works like IRAs. If you have multiple 403bs, you can take them from any combination of 403bs you want. So, going back to our question, got 2 IRAs. How many distributions? 1. 2 401ks, how many more? 2. Total of 3. And 2 403bs, how many more? 1. That gets a total of 4. That's how we arrive at 4. Now again, this is not some oddball scenario that we're never going to run across. And it could create big problems. I'll give you the best example I have. Was doing a program similar to this at a presentation a couple of years ago. Advisor came running up afterwards and says, "Oh no! I told my client, my biggest client, to take his $120,000 IRA RMD from his 401k. And I looked at him and I said, "Well, why'd you do that?" And he said, "Well, because we manage the IRA." Yeah, you get where I'm going with this, right? Yeah. I said, now, there was also good news and bad news. The good news was that this was in November, and this happened in February. That's the good news. So fixing the RMD issue was no problem. Just take more money. Take $120,000 out of the 401k. Problem solved. But if you've got a $120,000 RMD, you think you've got a lot of other income too? And do you think that person wants to pay tax on another extra $120,000? Absolutely not. So it ended up that they went for a private letter ruling to roll back in the excess, $120,000. Ended up being at a cost of roughly $50,000, but the advisor saved the relationship, right? They saved the relationship, but $50,000 and a heck of a lot of stress to do it. Cannot let that happen. So everybody should take an inventory of what type of accounts your clients have and make sure these distributions come out effectively. And by the way, under no circumstances, it's highlighted, bold, and italicized for a reason. Under no circumstances ever can you take an RMD from one type of account for another type of account. Even IRAs and 403bs, which have a similar rule, you cannot combine between them. All right, how about annuities? Just bring this up real quick. Yes, ma'am. How about 401A? I love it because someone always asks about either 401As or 457. They say, well, you said 403Bs are the only exception. How? I say, which part of this is the only exception? Right? It's the only exception. It's a good question. Always comes up. It's the only exception. 403Bs only. Every other plan you have to calculate and take separate. Includes, people always ask the 457s because they say, well, 403Bs and 457s, the same people have them, right? They do. But they don't have the same rules. Every single plan other than 403bs. Now, with respect to annuities, IRAs and 403bs have this aggregation, right, that we can do between them of the same type of account. That ceases to exist once we annuitize a contract over a lifetime or joint lifetime. Okay? In essence, what the tax code does is it says, hey, once you annuitize it, it switches from being an IRA to being its own mini-defined benefit pension plan. And just the same way you wouldn't aggregate the client's pension with their other RMDs, you can't do that once it's annuitized over a life expectancy or joint life expectancy. Now, that's annuitization. not a deferred RMD with a guaranteed withdrawal benefit or something like that, which your clients may have come across. I know in here, most of you, if not all of you, don't do that sort of business, but you may have run across it in the past. And so just keep that in mind. Also, the other question that comes up from time to time is, what if it's not a joint or individual lifetime? What if it's a 7-year SPIA? How does that work? And I will tell you that there is no good answer. There's just no good answer. It's one of those other gray areas out there from the IRS. And I will tell you that my interpretation, at least, is that once you hit 7.5, anything that comes out of an annuitized contract is the RMD for that contract. So even if it's an acceleration of the income, it's an acceleration of the income you have to live with. Some other RMD aggregation rules. No aggregation between spouses. Okay? Seen this before. There's actually a court case where the guy was a judge and went to tax court and said, hey, I took my wife's RMD from my account. Give me a break. That was his whole argument. Give me a break. The tax court said, nope, not going to happen. You owe the 50% penalty. And you can't even aggregate between your own IRAs and those you inherit. In fact, you can't even aggregate between inherited IRAs that come from different decedents. And you can't even aggregate between inherited IRAs from the same individual person if it didn't come directly to you. For instance, mom dies and leaves her 2 kids her RMD 50-50. One kid dies and leaves it over to the other one. Those still have to be segregated for RMD purposes. So lots of different things. In general, if you're not sure, just take it separately. Right? If you can't remember all of this or you don't want to deal with it, just take it separately. It's that simple. All right, how about qualified charitable distributions? I would say this is one of, yes, sir?
You have a rollover towards the end of the year.
Uh-huh.
From 401k into an IRA.
Uh-huh.
It's an IRA, right?
Good question. I'm going to actually, so I'll actually move ahead. It's on, I think, the last slide we're going to cover, but it's a great question, so let's take it now. Question was, hey, if you're 7.5, can you, and you have a 401k, can you roll it over to the IRA and then just take the RMD out of the IRA? The answer is no, for 2 reasons. First, where does the RMD begin? In the 401k, so you have a 401k RMD, right? Can you take a 401k RMD from an IRA? No! So we can't do that. But there's an even more important rule. It's the distinction that never gets made. The difference between a trustee-to-trustee transfer and a direct rollover. It's so interchangeable in every other instance that practitioners, even like myself, we sometimes use the words interchangeably. And it's not the same thing. They're both ways to move money directly. So yes, we don't have to worry about mandatory withholding. Yes, we don't have to worry about the once per year rollover rule. Yes, we don't have to worry about the 60-day rollover rule because it's a direct movement of money. But a trustee-to-trustee transfer, like an IRA to an IRA trustee-to-trustee transfer, is a non-reportable event. There's no 1099 issued, right? There's no 5498 issued when your IRA gets the money. And so because of that, a trustee-to-trustee transfer can move the RMD with it. A direct rollover, well, let me start by this. Everything can get rolled over other than a select list of items that are outlined by the tax code. It goes the opposite. It says you can roll over everything except for these items. So on that list would be things like 72T distributions, which obviously if you need them, you shouldn't be able to roll it over. The distribution to a non-spouse beneficiary, right? That's where we get a non-spouse can't do a rollover from. And perhaps most importantly and critically, required minimum distributions. Required minimum distributions can't be rolled over. Now, it doesn't say required minimum distributions can't be indirectly rolled over. It says required minimum distributions can't be rolled over. And guess what? Anytime you go from a plan to an IRA, it's a rollover. The question is, what type of rollover? Is it a direct rollover or an indirect rollover? But it's always a rollover. And so what that tells you is before you take your RMD before you take a distribution of any of that other money to move somewhere else, say to an account that you manage, you have to first take the RMD from the plan. You can't do it from the IRA afterwards, and you can't ignore it. It has to first come from the plan, and then you can roll over any of the remaining balance. Now, I don't like to name any companies, but some of you may know who this might be. There's a specific company out there that is particularly egregious at this. You have to use the jaws of life to get money out of that plan, usually over a 10-year period. Yeah, now some of you are like, I know that company, yes. Yeah, right? It's impossible to get money out. Sometimes, depends on the contract, right? Now, if the client is 67 when they start taking those 10-year distributions, you don't have to worry about anything. But when they turn 70 and a half, there's almost never an adjustment made. Money is still going from the plan right into the client's IRA through one of those transfer payout annuities. They can't do that. There's an RMD from the plan. I will tell you, in dealing with these situations over the years, how do we typically fix it? We take it out as an excess contribution from the client's IRA. Because the issue is not that you didn't do your RMD. You did. You got everything out of the plan. The issue is you took something out and then put something that couldn't go back into the plan, which creates a 6% penalty for every year. All right, good question. So, whoops. Now let's move on to QCDs here and talk about why these are so important in today's climate. Primarily, it's because of the tax law change. Okay, but it's also important for any high-income individual who may have things phased out due to AGI, etc. I like to think of a tax return as a football game. Now, I know that's a stretch for some of you, but go with me. Now, not this wacky postcard monstrosity we had last year, but I'm going to take you into the way back time machine of 2017. Remember that 1040, the real 1040, right? At the bottom of page 1, what was that amount? AGI, right? Or you could be a rebel again and look at the top of page 2, right? All right. So that is essentially the halftime score. Now, halftime really matters on your client's tax return, unlike some other things. For instance, like the Super Bowl a number of years ago when the Falcons played that team with a P. Yeah, I'm a diehard Steelers fan. Yeah, I'm a diehard Steelers fan. Can't say their name. It's like Voldemort. You turn to stone. But anybody know the score at halftime of that game? So 28-3 is the most common score that's mentioned. It's actually not correct. The score at halftime was 21-3. The Falcons scored early in the second half, and then it became 28-3, and then that other team did all that really bad stuff, right? Now, if you take away nothing else from this program, now you learn. Now, here's my question, though. How is it that it's the most popular game, it's a historic event in terms of the comeback, and yet nobody knows the score at halftime? Why? That's right. Who cares? It doesn't matter. It was irrelevant. The team that was kicking butt didn't even win. So, unlike, though, that type of instance, and what applies in almost every other aspect of life, the score halfway through doesn't matter. On your client's tax return, halfway through is really important. AGI is a key. Think about what's phased in or phased out in terms of credits, deductions, exemptions, things like Medicare Part B premiums, how much your Social Security. For some of you that have clients in different areas with real estate property tax breaks, they're almost always keyed to AGI or MAGI, not taxable income. No one cares about that. The only thing that I could think of that's tied truly to taxable income is the new QBI deduction. That's it. Everything else looks at the halftime score. So imagine you give a boatload of money away in a third or fourth quarter expense, right? Like an itemized deduction. Doesn't change halftime score. If you gave $1 billion away, if you had $500,000 of income, and you gave away $1 billion to charity, guess what? Your AGI is still $500,000. You still have very high Medicare Part B and Part D premiums, and all those other things that could be phased out, right? So when we're looking at a QCD, this is the way to give money directly from an IRA to a charity. And the benefit is that we never add the income to the return. Now, you don't get a deduction, but it's better not to ever add income to the return. Simple example would be this. You've got a client, couple, 69 years of age. And just to keep things simple, they have $250,000 and it's all interest from the bank. So at today's interest rates, they have like $4 billion in the bank, right? Now, this year, if we look at their 3.8% surtax, well, they pay it on the lesser of their total net investment income, which is $250,000, or the amount that they're over their threshold. Their threshold is $250,000. Well, they're $0 over their threshold. So I've asked a lot of tough questions, but let's do a confidence building one now. Which is less, $250,000 or zero? Very good. All right. So 3.8% times 0, I'll take the question in just a moment, is 0. That couple has no surtax. Fast forward another year. They say, hey, we're coming in to see you. And we've got our RMD. And just to keep our math simple, it's $100,000. We've got a $100,000 RMD. We want to give it all to charity. And the loser advisor down the block says, you know what? That's good. What you should do, that's a big contribution, photocopy your check. Make sure that you can show the IRS, because they're going to ask. And when you get the letter from the charity in the mail, make sure you keep a copy of that to show the accountant. Do those things right. Well, sure enough, when that money comes in and they put it into their bank account, it adds to their income, right? Now their income is $350,000. Now, will they get a $100,000 charitable contribution if they give that $100,000 now to charity? Yeah. They will, sure. They'll get it as a below-the-line deduction. Their taxable income is $250,000. But now, just to use this 3.8% surtax as an example, we've got to do our calculation. They still have $250,000 of investment income, but now they're $100,000 over their threshold for AGI. The lesser of those two is $100,000, 3.8%. They just spent $4,000 nearly in surtax. Now, on the contrast, if you had told them to do a QCD and do it directly from the IRA to charity, their AGI and their taxable income would have stayed at $250,000. It's pretty powerful. And by the way, that's for a client before we even get into the whole itemization issue, right? You don't get to take any benefit for charity until you exceed your standard deduction. A married couple this year where both individuals are over 65, which is most often the case if one is over 7.5, they get the double extra standard deduction. You have to exceed $27,000 of itemized deductions. Where are they doing that? How? They've probably already paid off their mortgage. They only can use $10,000 of state and local income tax. If their income is really that high, they're probably not getting anything on medical. So they're probably not itemizing their returns anymore. And if that's the case, not only are you then adding to the AGI, but you are also adding to the bottom line taxable income. So it's even worse for those people. So bottom line, the QCD should be used. A few items I want to mention, then I'll take the questions on this, just to point out. First off, a lot of mistakes in the year the client turns 70.5 here. Why? Well, because if your client turns 70.5 on December 30th, like Nick in our example before, what day, remember Nick turned 70 on June 30th this year, turned 70.5 December 30th this year. What day would be the earliest Nick could have satisfied his RMD? January 1st, right? You can take it any time. I mean, if the company's open January 1st, so be it, right? Or January 2nd if it's the day after New Year's. You can take it right away. It's just for that year. Well, guess what? If Nick wants to do a QCD, the only 2 days he can do it are December 30th and December 31st. You must actually be 70.5 in order to do it. Why? Because I need a job. That's really the only answer I can give you. There's no good reason for it. Next, I want to point out this one. Can't be to a donor-advised fund, can't be to a private grant-making foundation, can't be a split gift like to a trust. And finally, the last one on here, absolutely critical. Has to be entirely deductible had it been made with non-qualified funds. Now notice I didn't say mostly deductible except for a de minimis. I said entirely. So what's the issue here? Well, anybody ever give a nice gift to charity? Maybe let's just make it $10,000. And charity sends you back a letter in the mail that says, thank you so much for your donation. Your $10,000 gift is going to help us so much. And for your $10,000 gift, we want you to know that $9,997 is deductible because here's a free coffee cup with our charity's name on it. That sounds great, right? The problem, though, is that it is now not entirely deductible had it been made with non-qualified funds. It's except for a de minimis amount, but that doesn't apply. So now, even if everything else goes well, you don't have a QCD. You have a regular charitable contribution. Add it to your income, and then take a regular charitable contribution deduction. Well, our couple that had that $250,000 of interest, that would have cost them $3,800. That would have been a $3,800 coffee cup. Even Starbucks at a hotel is not that expensive. Cannot let that happen. I've actually got on the phone with our clients and like pleaded with the charity, please don't send us your free stuff. It's too expensive. It's ridiculous, but that's what you have to do. One more point here before we take questions on the QCD. This last one at the top, I left the old lines on here. I know these aren't the current lines, but nobody knows what the current lines are. Nobody's paid attention. So it's old line 15A, old line 15B. Going forward, it's line, I believe it's line 9 now. What's that? 4A and 4B? I think it's 9. I could be wrong. I'm going to take your word for it. Bottom line, your reporting is done on the return. There is no special code. So I get calls like this all the time in April and March. I say, well, I got this 1099. I did a QCD. Where is it? How do I tell my accountant? Just like that. Tell your accountant. You have to do it. Now, your client won't remember this or know this, so really it's something that you should do. Find out who your client's CPAs are. What a great thing to do. Write them a letter and say, hey, we did this transaction last year because we thought it would save them money, etc. Bottom line, it gets reported on the return like a rollover does. Gross amount, whatever it is, and then on the taxable side, you write 0, and next to it you go QCD. So IRS knows it was a qualified charitable distribution. All right, a couple questions on that before we go forward. I know there was a couple. Yes, sir?
Does it apply to inherited IRAs when the inherited IRA leaves owner?
Yes, a good question. Does it apply to inherited IRAs? Yes, but probably not in the way you would think. You would think it's if the decedent was 7.5. Nope. The person who is now the beneficiary has to be 7.5. And it does not apply, by the way, to 401ks, 403bs, etc. This is an IRA-only rule. So one of those things that you might want to do is if your client is interested in this, do a rollover to an IRA first. And remember, don't wait until the year they turn 7.5 to do it. Because once they're 7.5, they have an RMD. And we just learned you cannot roll over an RMD. So you can't roll it over and then do it afterwards. You could still use the QCD, but it won't satisfy the RMD. Right? It's just voluntarily giving money to charity, which is certainly fine, but is generally not what clients are looking to do. Yes, sir? No. You could essentially, I would call it like a disclaimer of a gift. You know, it's not the legal terminology, but yeah, as long as they don't ever send it to you, you're just writing them a check and you're saying, here is this, I don't want anything in return. It's not like they sent it to you and then you're giving it back. And even if they do, if it's a mistake, you could presumably send it back if you told them if they didn't follow your instructions. But you do want to be cognizant of that. Yeah, nope. No, I mean, they shouldn't, right? Because if they, especially with that notice from them, you should be getting if you don't get anything, you should be getting a notice that matches up with the amount that you gave them. So that's where those long phone calls come in, yeah. And so for those reasons, if a client is going to give more than their RMD to charities throughout the year, we'll select the ones that are most easiest to deal with. Like they're typically a house of worship is really easy. Like, hey, it's the guy or the girl at the house of worship who writes these things out every year. Let's just go to them and say, don't give me anything, you know. So we'll try to do that. But yeah, otherwise, that's where those long, annoying phone calls comes in. Yeah. And just keep in mind, it is either direct to charity or a check made payable to the charity. That also works. So if your clients have either one of those IRA checkbooks, which I don't love, or if they just have the custodian make the check payable to the charity, that works. All right, just a quick, yes, sir? Excellent question. Yeah, that's a problem. So in the checkbook IRAs, the question was, what if they write the check on December 20th, but the charity is busy doing charity things and doesn't get around to cashing it until January 5th of the following year? We've seen that be an issue before. So you do want to make sure that check gets cashed. It's actually one of the reasons why, again, I don't really love checkbook IRAs. I would much prefer the custodian cut the check themselves, because if they do, they'll typically issue that 1099 regardless of whether the check is cashed or not. All right, something else to keep in mind here, QLACs. You may not have paid too much attention to these things. What are they? They're qualifying longevity annuity contracts. I know the second I say annuity, what some of you hear is all right. Now, what I will say is this. Typically, the people who dislike annuities more than any other groups are academics writing papers and CPAs. They have historically been the two groups that dislike these things the most. And I can tell you that, being out at the AICPA conference for the last few years and presenting there and, listening to just about every retirement income presentation I could get my hands on or get to, it is amazing because every single expert, CPA, academic talking about how to mitigate longevity risk is talking about these types of contracts as being one of, if not the best way to do it. Right? And primarily it comes down to the mortality credits. People don't like these annuities. Why? Well, one is because they say annuity, and two is because you're parting with your money. What you're doing here with a QLAC is you're giving up to $130,000 or 25% of the client's applicable retirement account balance, and you're putting it into an annuity that is not intended to be started until much later. And the reason IRS created these things, and by the way, this was done by regulation, not law. This was all done by Treasury regulation. The reason they did this is because annuities have historically posed a problem within retirement accounts. Because if you think about it, let's say you put money into an annuity at 65, and you really don't want to touch it yet because you're worried about living to be 100. That's your concern. What if I live too long? Not what if I die too soon? Well, you don't want to take the money out at 70 and a half, right? Because if you do, it would be a lower annual amount than if you waited, let's say, until 75, 80, 85, right? By definition, the insurance company is covering you for fewer years. They're on the hook. They'll give you more annual income the longer you wait to start it. So you'd say, okay, I don't want to take money out, but you have to take an RMD. So you could only, if you wanted to not start that income, make it up from like another IRA. But that means you're burning through your liquid money in the IRA faster. So IRS came up with this rule, and they said, if you use one of these QLACs, you can put up to that $130,000 amount, and it won't count towards the required minimum distribution. Okay, you could exclude it from that calculation and lower the client's RMD by, its starting amount by about $5,000 or $6,000 a year. So fairly meaningful, and in essence, the cost of the contract, if you actually back out what the insurance company is actually charging, is pretty much made up by the deferral that you get by waiting until 85. It is not a panacea for living a long time, but it's certainly a really good tool, and I would just encourage you to consider them in your planning. Again, when people hear annuity, they just kind of shut down a lot of the times. I don't get anything, and I'm not here to sell you on annuities or anything like that, but I will say they're a pretty good tool for longevity protection, and you do get that deferral of the RMD with it. Just note that they have to be fixed annuities, and you really want to be careful before you use these things because that old rule of caveat emptor, buyer beware, applies. Once you put money in, it's like the Roach Motel. Money checks in, does not check out. Okay? There is no surrender benefit, there's no commutation benefit, nothing like that. It's just gone. So the question is is it a regular annuity? It's a qualifying longevity annuity contract. It has to meet certain IRS provisions. It's only offered in a deferred, like an IRA, 401k, 403b, etc. And you have to start taking income by the first day of the month following the month you turn 85. Yes. Is the maximum, or 25% of the account balance. Good question. So per plan. There's always deeper, right? We can always go more deep. More deep. Very good. With respect to IRAs, it's actually as of the prior year end, and you can lump all IRAs together, kind of like with RMDs. With plans, the 25% is applied on each individual plan, and it's as of the last valuation date, which is generally the last statement. So if you had 3 401ks, each with $200,000, you could only put $50,000, let's say, at most, into any one of those 401ks. If you had the same thing with an IRA, you could use all their total balances and buy one $130,000 IRA QLAC. 130 is a across-the-board maximum for all plans, retirement accounts. You can do more, right? You could do more than that. It just won't be a QLAC. It'll just be a regular deferred immediate annuity where you're back in the old problem of, do I start this or do I take money out from another plan? 130 period. That's the most. So interestingly enough, the regulation said it started at 125. The regulation said we will adjust in $10,000 increments, and IRS didn't follow their own rules, and they realized it after the fact, and they said, "Oops, We're just going to leave it for now. Nobody say anything. That's essentially what happened. So it'll get adjusted to 135 at some point, and then to 145 and so on and so forth. But not a big change. And one last point here, when you're using these in practice, right? Good question is, what do they actually replace? Because typically, it's a fixed annuity. You would count this towards someone's bond allocation, right? Their fixed income allocation. But to the other point, you generally leave the equities for the last money that you spend, right? It's your long-term money. You have a longer-term time horizon. Well, that's what this is for. This is for when you're later on, when you're like 85. So do you replace stocks or bonds? I generally still lean towards fixed income, but it's worth discussing. All right. Just a quick note here on some couples. First off, if you've got couples of different ages and you can only afford to contribute to one account, contribute to the younger person's IRA first. Or the younger person's 401k. Max out that person's account before you go to the older person's. You get a little bit extra referral. Similarly, if they are taking money out, let's take out distributions from the older one, and you could potentially recycle them into the younger person's. Now, yes, they have to be working, but you can essentially recycle those distributions as well. And bottom line is, when we have spending, do all your spending from that older person's retirement account first. Decrease that RMD load from that account. All right, I'm going to go ahead and move past this. It's just a summary slide for you. If you happen to run into a mistake, we've got about 7 minutes left here. So if you happen to run into a mistake, I'm going to suggest that you fix it, okay? Fix it. Do not pass on fixing it. There is a court case out there that essentially said if you don't file Form 5329, which is where all those IRA and plan penalties get reported, you don't have a statute of limitation for those penalties. We can go after you indefinitely for them. It's the Paschal case. It happened back in 2011, and IRS has used that as a tool to go after people since. In other words, this isn't just some theory that the IRS came up with. They've used that now and said, hey, even though you filed your 1040 like 8 years ago, you never filed this 5329, and so we're going to hit you with either excess contribution penalties or failure to take your RMD penalties, etc. Now, on the other hand, if you find a mistake, say you took an RMD from a wrong account, and you go and fix it, and you do a mea culpa to the IRS, and you act like a kid when you made a mistake. You go, oh, I'm so sorry. I promise never to do it again, and here's what I'm going to do to fix it. The IRS will almost always give you the relief on the penalty. If they find it, it's a different story. But if you go to them and you file a 5329, first make up the distributions, right? Take them all out. Generally, if you've got multiple years of missed distributions, I like to take them as separate amounts in different checks, just so it's easy. You photocopy each one, send it to the IRS, 2019 distribution, 2018 distribution. You file a 5329 for each year that's missed and for that year. So if you missed the 2017 distribution, file the 2017 5329. If you missed a 16 distribution too, file a 2016 5329 and attach a statement explaining the reasonable cause. Person is 75 years old, not in great cognitive ability, doesn't have the cognitive strength. Person relied on their CPA or advisor. That's a great one. Now, not great if you're the CPA or financial advisor, but it will almost always get you out of this issue. Yes, ma'am.
So even if you're not filing a 1040 for that year, I'm understanding you should still file a 5329 as a standalone.
You could file a 5329 as a standalone if you didn't file a 1040, but only if you have the penalty, right? I mean, if you made a mistake. Otherwise, you don't have to. Some people have suggested maybe I should just file 0 5329s. I don't think that's a great idea. I differ on this, so there are some people out there who think that's a great idea. I believe Natalie Choate actually is a big supporter of it, and I respect Natalie, tremendously. I just differ in the sense that if you're only filing one form with zeros every year, A, it seems a little weird. It might draw attention. And B, you have an indefinite statute on fraud. And again, if there's only one form you're filing with zeros, I think the IRS's argument about fraud is a little bolstered. Like, in court, why is this the only form out of all the forms that you filed? I think it strengthens their argument. So I wouldn't do that. All right, that's the case, by the way, I mentioned before, where they ruled that if you don't file the form, you have no statute of limitations. So if you want that case, the site is in your notes for you. Lastly here, just a few other issues, liquidity issues. Sometimes we find clients with those self-directed IRAs, and they own real estate and all these other illiquid assets in there, which is fine when you're young, but what are you going to do when you hit 70 and a half? Right? Like, you got to come up with a plan for this. It's different, right? If you own shares of Apple, you can distribute shares of Apple. You could sell it. You can do a lot of different things. If you own a building, what do? You can't like distribute the bathroom one year and the kitchen the next, and then that's just not going to work. You could create like an LLC inside the IRA that's owned by the IRA, then fund the LLC with the property, but it becomes a nightmare. Because now you're going to start distributing, and you got, let's say, property taxes that are part have to be paid by you personally, part have to be paid by the IRA. And it's just a nightmare. You could convert to a Roth IRA before, not have to deal with it. But bottom line, you need a plan. Timing the distribution within the year. Lots of times clients like to wait until the end of the year so you get the maximum deferral. And actually over the course of a lifetime can make a meaningful difference. But remember, if you wait until later in the year, you can't do anything sooner because of things like that first money out rule. The RMD is considered the first money out. That means the first money you take out of your account is the RMD, whether you want it to be or not. So where does this come into play? How about Roth conversions? You like to do Roth conversions? You want to do a conversion early in the year? You can't do it until you take the RMD. Because if you don't, the first money out is that money that's getting moved into the Roth. And a Roth conversion is nothing more than a special type of rollover. And remember, you can't roll over an RMD. So if you put all those things together, if you don't take your RMD first, you cannot make a Roth conversion. So all these things come full circle. They're all intertwined. And at the end of the day, it just makes things so much more complicated. This last point is the one that we addressed earlier, that direct rollover versus transfer. But it all works itself into meaning that clients need you more than ever. This stuff is so much more difficult than it would appear on surface. It really is one of those iceberg areas. With that, I will stick around. I know you guys have a break. I'll take any questions you have. But as always, thank you so much for your time, and best of luck for continued success.